FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 5/29/19. We're almost done with May. It would have been probably not a bad idea to sell in May and go away, but you didn't. I didn't. So here we are picking up the pieces for sure. Well, everything revolves around the Federal Reserve. Life as we know it would cease to exist if the Federal Reserve were to close up shop and fade into the dustbin of history. But you know, that's not going to happen anytime soon. Well, inflation, big issue. And you know inflation's important. Tell us what you think about inflation. Email us, kl@kerrylutz.com. Best part of the show is getting your emails. And I'm about 200-300 behind, but I will catch up in the next 3 days. I have pledged to do it. Well, Jeff Socha is with us now. Jeff, you've been talking about Fed officials, their past misses. What are they going to do for inflation? How are they going to redefine it? Redefine inflation as we know it. Maybe they're going to make inflation great again. Anyway, welcome back. So making inflation great again. How do we do this?
Hi, Kerry. I love that, making inflation great again. Right now, I think everyone is just so focused on the potential of the U.S. expansionary period coming to an end that they're really forgetting the real possibility of a stagflationary environment to become the new norm in the United States. I mean, one of the key aspects of our monetary policy has been anchoring expectations for inflation. Right now, with the unanchored inflation expectations, it causes a temporary spike in inflation to actually move the dial upwards and stick inflation at a higher rate. Mm-hmm. So with that being said, I really think the only way to decrease the expected rate of inflation and really reposition those expectations would be a recession that might come through monetary tightening and policies.
Mm-hmm. So what do you think is the real inflation rate? There's a lot of debate, Jeff, over that. Are we seeing inflation? I always like to look at my favorite indicator, and I think it's so accurate, is the price of a Thanksgiving dinner. And it's gone down the past couple of years. So what do we got here? What's your take on it?
Well, if we look at interest rates as another metric, the low rates we've seen, are really a misinterpretation of the natural rate of interest. This 2% is really an arbitrary number that changes on a sliding scale, and we've been chasing after that 2%, which is now really 2.2, 2.7, kind of increasing. And that's been the interest rate for almost 10 years now. So the approach needs to be more aggressive to really re-anchor those expectations for inflation.
With higher,
with the
right?
Potential of, so you take a look at the different aspects of inflation. I mean, hyperinflation could pose a series of problems, in all areas like labor and workers facing, wage risk and constant renegotiation of their pay. So, there's different aspects that are all tied together here.
Mm-hmm. Yeah, I know. There definitely is something more to it than what the Fed is saying. Because look, if you look at your health insurance, your auto insurance, property and casualty, all of those things have gone up dramatically over the years, and they go up every year. I get my bill from Geico. It's guaranteed 5 to 10% higher than it was the year before. What am I missing here?
Well, the short run inflation, some of these short term increases and changes, that's not really expected. That can be expansionary just due to increased output and real output. So that could be a factor coming into play. Part of it too is just business cycles and business policies. So, if your insurance premiums are going up, everybody is going to use this time period as an excuse to raise rates. It's hard to raise rates when things are going the other way. So part of it is just businesses taking advantage of the timing to increase pricing.
Mm-hmm. So it's harder to increase prices when the economy is contracting, but when it's expanding, people have more money. It's almost like they're expecting to pay more for things. than they
Yeah,
would.
exactly. I mean, in recessionary times, if you're going out for that Thanksgiving dinner, the restaurant really wants you to come in. So they can't keep raising the rates. They've got to make it attractive so that you don't start contemplating, well, I'll just eat this meal at home.
Mm. Yeah, and people do have more money by the nature of things. The money supply is expanding in all likelihood at a higher rate. Even if the Fed isn't being overly accommodative, the private uh, the private market, the banks, they're lending out more money, and they're effectively, when a commercial bank loans money, they create money, which many of you don't know out there, but the very nature of creating loans on bank books leads to inflation in the money supply.
Yeah, exactly. And, it's like I was saying, part of this is also pricing strategy that shows up that people think, okay, this is all inflation. But, one pricing strategy is simply to keep increasing your price until people start complaining and stop buying your product, and then you just pull it back a notch. So right now, I think you're seeing that. We've got a really low unemployment rate, so labor shortage. Resources are scarce as far as increasing output. And so businesses are taking advantage of that and raising rates until, people stop buying. And so part of that looks inflationary, although I don't know that it really is. I think it's actually just a sign of how strong the economy is going right now.
Yeah. So obviously, inflation rate under the quantity theory of money, the more money you have chasing a fixed amount of goods, or even a pool of goods and services that are expanding, but less than the rate the money supply is expanding, will lead to higher prices. That's the very definition of inflation. Milton Friedman said it best: inflation is always a monetary phenomena. He didn't say it exactly that way, but he says it's an inflationary phenomena. Rather, inflation is a monetary phenomena. And I guess we lose sight of that fact because we've seen the money supply go up so high, so fast for so long, yet not see consumer prices really match it. But where you have seen it is high-end luxury items. And that really is kind of the line of demarcation of a income inequality increasing. It's really in large measure due to inflation, because the ones who benefit most from inflation are the ones whose incomes go up. But Joe Sixpack, a Main Street Bob, they see their purchasing power and their quality of life, their standard of living, going down from these very policies.
FSN Radio. It's all about what's next.
Egypt is on the verge, once again, becoming a world-renowned gold producer. The Golden Age is being rediscovered. For millennia, ancient Egyptian kingdoms prospered from unparalleled riches. Pharaohs built their empires and flaunted their abundant wealth that was made possible by the country's resource-rich gold deposits. Despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. Aton Resources is at the center of the modern Egyptian mining world, diligently working both as the only public exploration company in Egypt today and as the advocate for mining reform with the Egyptian government. However, those that arrive early like Aton will reap the best rewards. Aton's discovery of the legendary Lost Mountain of Gold at Rodruin and its current aggressive drilling program there could potentially reap those rewards. Aton Resources is focused on its 100% owned Abu Marawat concession in the Arabian-Nubian Shield, located 200 kilometers north of Centamin Sakari's world-class gold mine. Aton possesses first-mover advantage in the under-followed jurisdiction of Egypt, which is currently undergoing mining reform. To stay on top of Aton's latest drill results and news, go to atonresources.com. Aton trades on the Toronto Venture Exchange under the ticker AAN and on the OTC under the ticker ANLBF.
The Financial Survival Network. It's all about what's next.
Right. Well, just like you say, there's been a real ease in borrowing. And with this period, we've got the asset prices increasing. So, your average Joe out there isn't going to own a portfolio of commercial real estate whose value is appreciating with the times. that's making that person wealthier, right? From the assets that they might own that go up with inflation, that are a hedge against inflation. So then when you have the average Joe or somebody who's more paycheck to paycheck, and then they're going out wondering, why are things getting more expensive? But the other people who have assets that go up with inflation, are taking advantage of it and not really blinking an eye at the 5% increase here or whatever the price increase is there.
Yeah, I gotcha. So they're in a quandary, though, right? Because you want to keep, the pressure from the president and the political sector is keep that money flowing. But on the other hand,
the thing to look out for there is, the way they're going to stop inflation, if they really get concerned about it, if the Fed does, they'll increase interest rates. And if they increase interest rates too much, then what you're looking for is an inverted yield curve, where the short-term interest rates are higher than the long-term interest rates. And if that happens, then you can bet that's going to trigger a recession. So the Fed knows that they can trigger a recession just by increasing the short-term rates high enough. So they're going to play that game as much as they can to get close without tipping the economy back into a recession. So, but that's really the metric you're going to want to look for. If short-term rates go above long-term rates, then we're really in for a big change.
So you think it's impossible to do in the long run what they're attempting to do here, Jeff, which is, kind of have it both ways and really kind of try to rein in the business cycle? Don't you think that's somewhat of an impossibility?
I'm not sure if that has worked. When you look in the past, these periods of growth, expansion, and then contraction are natural cycles. Because if you keep going where, hey, we want to increase the interest rates to kind of temper the economy a little bit just so that we can get more longevity out of it, what you end up with is essentially a flat yield curve. And when you look back in history, you don't see many periods of a really flat yield curve where, hey, Kerry, I'll loan you money for 1 year and you're going to pay me the same interest rate as if I loan you that money for 30 years. So that doesn't make a whole lot of sense just in basic economics. So you've got to have that yield curve actually needs to curve. And so if you try to just flatline it and say, well, we're going to try to keep us out of a recession, but temper the economy in the short term, you're just kind of, you're on a fine line there. It's a delicate balance.
Yeah, it really is. And we're kind of expecting the Fed to really do the impossible. It's like a deus machina, hand of God. In the Greek plays, they weren't really good at ending plays. So what they would do is the hand of God, it was actually a device, the deus machina, would reach down and grab the character out and save them. And that would be the hand of God reaching out to save them. I don't know what the Fed is supposed to do in this case because there's nothing out there to save them from their own foolishness or conflicting pressures that the economy puts upon them.
Well, the favorite move that the Fed has, if the economy does start contracting and we do start going into a recession, one of the things they love to do right off the bat is cut interest rates. So raising these interest rates a little bit and pushing that yield curve more and more flat is actually a good thing because it gives them some room to cut interest rates if the economy does start contracting. And a little bit of contraction is healthy. It's normal. It helps restart the economy. It helps people find efficiency. It creates some momentum and change in the economy. And so it's a healthy thing. But in order to keep that to be a short-term recession and not really like a 2008, the Great Recession style, having those short-term interest rates a little higher is actually a good thing because it gives them that tool back saying, okay, we can drop these rates again to try and spark the economy if it slows down too much. So it is a good thing, but it's kind of this double-edged sword like you're talking about.
Yeah, and it's challenging. It's a real challenge to manage this. I mean, the fact that they've done it this far for this long is pretty darn remarkable. It's we've seen other Federal Reserves really make some huge mistakes on this and really wind up, upside down, really doing more harm than good. as much as we all like to bash the Fed, you have to give them some credit for keeping this game going as long as they have.
Yeah, we're actually getting fairly close to breaking a record. Every 12-year period in history, we've had 2 recessions. So 2008 plus 12 years would be 2020. So if we can keep this thing going for, say, another year and a half, we're going to be into new uncharted territory of the longest expansion, bull market, positive growing economy that we've ever seen. So we're getting pretty close, and it's kind of a fun record to break if you think about it. I think everybody should be rooting for the Fed and the government and the United States economy to keep going, and let's set a new record so that now we can say, hey, instead of 12 years, we went 13 years.
That's great. Well, you know what it's like, though. It's like that guy that you see in the circus, and he's got the sticks and he's got the plates, and he's got like 20 plates up there, and he's keeping them moving and moving and moving, and he doesn't drop any. And then he's very skilled. He knows how to bring the plates down one at a time without breaking them. But the Fed has got all these plates, and I don't know that they know how to get them down without having 20 plates and shards on the floor. I guess we're going to find that out, though. We don't have a choice in the matter because this is the way things are running. So I know that you'll want to check out Jeff's work. Jeff, just tell us where we find you and how we find your writing.
Sure. So you can find ARK Financial, ARK Financial, on all of the social channels. Come check us out, see what we're up to. Give us some comments, follow us. You can also go to our website, arkfinancial.com, and reach out to us there.
All right, arkfinancial.com. The link is in the show notes to this interview. Appreciate you coming on, Jeff. And questions, comments, kl@kerrylutz.com is the email address. Twitter feed @KerryLutz. Facebook page, Financial Survival Network. Hey, whether you're listening to this on a podcast platform or on YouTube, please subscribe, like, and share. Really helps us a lot when you do that. Helps us get these ideas out there when you most need them. Jeff, we will talk to you again soon. Thanks so much.
Thank you, Kerry. Have a great day.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.